Hello there, traders. Welcome to the Markets in 3 with me, John, Senior Market Analyst here at Anzo Capital. Here today to show you what has been going on in markets overnight. Keep you up to date on the current news that's moving FX markets as well as upskilling you as a trader. So, today we're going to be talking a lot about what happened yesterday, what happened last night with the FOMC meeting, and then we're going to go into dollar yen. Is a Bank of Japan rate hike coming? The Bank of Japan are set to hike interest rates potentially going into tomorrow's meeting. So we're going to take a little look at that. So let's have a look first of what happened overnight, right? So we have some reporting here that I can just take you through on the news squawk. So we had a little bit of a bearish reaction to the US dollar, and I actually spoke a little bit about this and about watching bond yields in particular because they will be the real driver of what happens next for the US dollar. Now, what was really interesting is that we didn't really get anything from Fed Watch. Well, I don't know whether that was interesting or whether that was expected because in a way, we saw him just basically say that inflation has kind of come down a little bit, and things are a little changed. So they're just continuing to look at the bigger picture. So here's some reporting from News Squawk. Anyway, it says the Fed left rates unchanged at 3.5 to 3.7% as expected. However, the meeting produced three dissenting votes. The regional Fed presidents Logan, Hammack, and Kashgari all preferring a 25 basis points rate hike. Now, they also said last time that there should be a 25 basis points hike. So there's no real change there. The remainder of the statement was largely unchanged from June, continuing to provide no explicit forward guidance. We know that already. Fed Watch has come out and said he's not going to provide any forward guidance to the market. They're going to rely on the data itself. The committee also reiterated that the committee will deliver price stability, so very much focusing on the inflation side of the dual mandate. Okay. The Fed assessment of the economy was also maintained. The statement continued to note that the economic activity is expanding at a solid pace, while adding that productivity growth and capital investment are strong, job gains have kept pace with the workforce, and the unemployment rate has changed a little. Fed Walsh said the discussion was collegial and that there is no soft inflation target, as well as stated the economy is showing impressive resilience. So we talked about if he says that there is resilience, even with recent shocks, while trends are positive and reveals solid growth. Walsh said that the 5+ years of inflation above target cannot be cured in 9 weeks or by a single month of modest price decreases, but stated the Fed will not waver and that one key development has been that nominal and real yields are materially higher across the Treasury curve. So he's noting the fact that he's seeing what's going on with those bond yields and he sees that they are at elevated levels. Now, usually that means the Fed will go with the bond yields. Furthermore, he stated that where necessary and appropriate, they will not hesitate to act. So there is this kind of element that they have been, he kept rates on hold. There was three dissenters in that, but they were the same three as last time. But he's still focusing on that inflation side of the dual mandate. It goes on to say Fed Chair Walsh said that in the Q&A that they had a good family fight and that there was a lot of agreement that they can deliver stable prices, while he responded not much and that they are not relying on one individual piece of data in as how much was not hiking in July due to June's core CPI. Walsh stated in the period ahead that they have important decisions to make about the policy rate and will continue to watch market information to see how it responds and how it can help the Fed inform their decision making. Walsh also commented that inflation continues to remain elevated through a forecast period. Interest rates could well be part of fixing that, while they will not tolerate a higher inflation target and will deliver price stability. Furthermore, when asked about Jackson Hole being a reset for policy, Walsh said he looks at it like a blank piece of paper right now and would like it to frame the big questions while he will be checking with task forces before Jackson Hole. So again, really focusing on that inflation side of the story. Now, one tool that we always talk about here is the CME Fed Watch tool. Now, if you trade FX markets, this needs to be a tool that you look at every week, every day, okay? Because it shows you what market expectations are, and that's what currency markets are driven on. They are driven on central bank expectations, okay? So the Fed Watch gives us this tool, and the Fed Watch is basically what the 30-day Fed funds futures are pricing. This is what bond traders are trying to trade. They're trading that anticipation. Okay, so we went in the, so remember, we've got to look at this now. Things have changed massively over the past day. Okay, so when we looked at September yesterday, there was another column here, right, which was basically suggesting that there'd be a 50 basis points, potentially a 50 basis points hike, because what the market was almost anticipating was July there'd be a shock 25 basis point hike, and then pricing, another hike in September. They didn't get it. The market didn't get it, and this is where we currently sit, 350 to 875, and we can look at this table down the bottom here, and it tells us everything that we need to know, right? So look at a week ago. There was only a 17.8% chance that the Fed would hold interest rates in September. That has now jumped to 35%. Yesterday it was 24%. So as this develops, the market is now getting fearful that the Fed are not even going to hike interest rates, which could be the case, right? We've got to check out the next inflation data, core PCE, coming up next week. So if we look at you can see here, look, it's now priced at 0. So yesterday we had a 20.2% chance that we were going to get a 50 basis point hike. Now it's dropped to 0%. So that just shows you what bond traders are thinking about the interest rates in the future, right? They're saying, hang on a minute, we might only just get one hike. We went from pricing 2 cuts this year to 0 cuts to 2 hikes, and now it's back down to 1 hike, potentially. So we've seen this move as well. We were at around, so basically how this works is it does a collective together. So yesterday we were around about a 76% chance that we were going to get some kind of hike, right? That has now dropped to 65%. And the beauty of this is we can see this in real time. If you come over to a different type of trading software called TradingView, it just gives us a little bit of access to some other tools. So this tool here is a tool that I look at every single day. This is what's known as the US 2-year yields, okay? This is what's also known as the short end of the Treasury curve, okay? This is the one that usually the Federal Reserve are talking about when it comes to looking at the Treasury curve, right? Because if we put the interest rates on here and we just zoom out, I'm just going to make this a line chart as well. You can see that when US 2-year yields rise, right? You can see this all the way. This even goes back to 2015. Look at this. 2015, 2016, US 2-year yields were spiking. Look at that. We had a rate hike from the Federal Reserve. As they continued to spike, so did the US interest rate. When we started to see a turn, right, and one thing that I like to look at is the relationship between the 50 moving average and the 2-year yields. We broke through that 50 moving average, and then a couple months later you can see that the Federal Reserve started cutting interest rates in line with the 2-year bond yields. We remained flat through most of 2020 and 2021 until we started to see persistent inflation. Okay, now you can add the inflation rate on here as well. So if you type in inflation and make sure that you're on economy, it says here the United States inflation rate year on year. Okay, you want to add that to your new price scale, because this is what really drives market. When inflation is persistent, bonds will start to price that in. Okay, so you can see the green line here is the US inflation rate. Okay, and you can see that that starts to spike higher. US bond yields then start to follow, trying to price that inflation pressures in, trying to price in the idea that the Federal Reserve is going to do something. They then start to fall first, look, then bonds start to fall, then interest rates start to fall. Okay, look at this perfect example back in 2020, right? We started to see inflation rise, right? Bonds weren't really giving it a good opportunity because this was like COVID area, right? So they thought maybe it's just a bit of a shock. But then they pumped so much money into the system that that creates inflation, right? Because people have more capital to spend, and inflation rocketed, right? We saw a move all the way in January of 2021 around 1% for it to go up to 3.12%, right? So crazy moves there. Sorry, 5.4%. It went from 1.4 to 5.4%. Then look, bond yields followed. They tried to price that move in, and as they did, interest rates were hiked. Okay, so look at this situation we're in now. US 2-year yields have spiked above that 50 moving average. It's above current interest rates. So this is what's known as the spread between the US 2-year yields and the interest rate, right? So the spread at the moment, so interest rates are 3.7%, between 3.5 3.75%, and current US 2-year yields are trading at 4.2%. So there is a spread difference there. Okay, so that's what we always talk about. But look at inflation recently. It started to come down. That's largely due to the oil situation that we've got in the markets, because that's the whole reason why we had this spike here in the first place. Before that, inflation was actually starting to come down. It was stalling a little bit, but it was on average on the way down. Then we had the US-Iran war. It drove oil prices higher. So headline CPI went higher. Okay. Now situation we've got now is there were peace talks which drove oil prices to the downside, right? Just before, you could talk about the timing a little bit here, just before the Fed meeting, which would have left them on a bit of a pause. Remember, the grand scheme of things, Donald Trump doesn't want rate hikes. I'm just going to put that out there. Donald Trump does not want rate hikes. Okay, so isn't it ironic that he paused fighting over the weekend before the Fed week, and he paused all action until today, till after the Fed meeting, because what he's done is he knew that would drive oil prices lower. He's seen the reaction. And then he's just waited for the Fed to be like, well, actually, oil prices have dropped again. It might not impact inflation. We're going to hold. We can't do anything. It's too volatile. We're going to hold. Perfect for Donald Trump, because he wants lower interest rates. Okay. Now, this has got the bond market spooked. So we started to see a decline in those US bond yields. Okay. So if inflation starts to come down, if your likes of your core PCE start to come down, look at your core inflation, your PPIs. If they start to weaken, then the likelihood is that that's going to get priced in the bond market as well. And we'll likely see US 2-year yields start to decline. That would be bearish for US dollars. Okay. Bullish for gold, bearish for US dollars. Now, the thing with this at the moment, so let me just get rid of these now. And let's just go back to this US 2-year yield. We're trading in this little bit of a channel here, right? So the market is trading within this channel. You can see resistance, 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 and then support in lows all through this area here. So we're just kind of making our way through this channel. But the dollar should technically be supported unless we start breaking down here. And like I said, I look at the 50 moving average here for a while, and you can see that we spiked above the 50 moving average and spiked above all these highs around about March 26. And when we look at the US dollar index, for instance, we started to go on a real good run. So this was March. Look at that, March the 2nd. Started to see strong bullishness coming from the US dollar. We did get quite a sharp pullback in that, but the technicality, if you look at a weekly chart, was bullish. We made new higher highs. It pulled back into support areas, and has still remained pretty bullish. So we're going to see some decision making going on here now. We might actually see US dollars just range within this area here between 100 spot 50 and 101 spot 75, because the market's going to be waiting on what happens next. What's the next data point now? It's core PCE. Okay, well, if that comes in lower, does that mean we're going to break and see moves back down to 99.50? So there's a lot to be considered going forward. Now, obviously, the reaction yesterday was a bearish one. Dollar fell, and that's because, like I said, the short-term pricing on the CME Fed Watch tool is pricing the fact that we've gone from 50 basis points hike, so 2 hikes, down to 1. So the market, which was pricing in 2 hikes from this Fed decision here, on this one has now been disappointed. So we're starting to see that pushback to the downside there, and that could continue back into this 100 spot 50 handle. Okay, if we go take a look at gold, why is gold sort of trapped in this area as well? Because there's a lot of indecision. If there was if we do see this continuation of US dollar downside, then I actually don't mind being on the buy side of gold now, right? We rallied up into that 411.10 area, which was a strong area of resistance. We've come back down. Look where we've retested. So let me just show you this in a little bit more detail. Let's go to the gold chart here on the MetaTrader platform. I just want to show you the potential for an opportunity if we do see one. So let me just go to the hourly chart. Now this is the beauty of using things like institutional tools, right? So you can see the market consolidated in here. This was all the Fed meeting, right? Market even tried to spike lower, trying to get those orders in and around these areas here. We had the opposite effect. Market rallied all the way into that 411.10 area. But guess what this is down here? It's volume, it's accumulation. It's where big orders are getting accumulated. Now if I drag the adjustable market profile on the chart, if it'll let me do it. Oh, here we go. It's just stalling a little bit. We've got lots of tabs open at the moment. Look at all that volume down in here. Right? So you got 3 areas to look at. You got the value area high, value area low, point of control. Point of control is the area I like to look at when it comes to seeing an accumulation, seeing a breakout. That zone there is where I like to start looking for opportunities to get on the back of it. Because what we've seen is institutions have driven prices out of there. So buyers have won. Are they going to defend these orders down here, right? So looking at this, we can see that's where that volume started to kind of build up. Let me just change the colors of this so you can see it a little bit better. That's not what I want to do. Let's cancel that, sorry. Let me just go to indicators list, adjustable market profile, and we're going to just change the area here. I'm just going to change it to the dark orange so you can see that in a little bit more detail, right? So you can see all that volume just being built up in this area here. Prices come down into that area and look at the reaction. So you could easily have a look at opportunities like this all the time. You see an accumulation, you see price break out of the accumulation, it comes back in, it retests. Okay, look at that 30-minute chart, 15-minute chart, a little bit of a breakout forming here. So this could be a good opportunity to see gold go long as those US 2-year yields start to come in a little bit lower as well. If we start to see these drop off, gold longs could be in play. Now we did see a rise in the 10-year, so that means that the longer end or the sort of mid-range thinks that inflation is going to rise. So you've got this kind of battle. You've got the short end of the curve, which is trying to battle the sort of Fed decision, and then you've got the 10-year, which is starting to kind of see a push to the upside here. So which is super interesting to see. So yeah, I mean, the reaction has been a bearish one for US dollars, but the interesting thing is those bond yields. You got the 10-year rise and the 30-year rise, but you got the 2-year falling. I think if the 2-year continues to fall, we should see US dollar continue to weaken in the short term. Okay, so that means that we've got to wait for the next decision going into next week. So let's move on to the next story then. So the next story that we wanted to talk about is something called the big story, and in the big story I like to talk about the kind of like a big event that's upcoming in the markets. So yesterday we talked about Bank of England. Today we're going to talk about the Bank of Japan. So let's have a look at dollar yen and where dollar yen is currently trading. So dollar yen is currently trading up at the 163.60 handle, right? And there is a lot of talk of what potentially could come from the Bank of Japan, right? So when we take a look at the interest rate tracker here, we can see that the BoJ is forecast to hold interest rates at 97, with a 97.1% probability. On the cut side, they've actually got pricing in a potential 2.9% cut, but the bias is hawkish. So that's a bit of a contradiction there from markets. It says the majority of BoJ bankers are hawkish, right? The overall tone is hawkish because the majority of recent comments indicate strong concern about inflation risks and readiness to continue raising interest rates. Multiple sources suggest that the BoJ is likely to maintain its policy guidance to raise rates, with a significant number of economists predicting rate hikes in the near future. The emphasis on the potential for inflation to overshoot the 2% target, along with the warnings about the consequences of delaying policy adjustments, reflects a cautious stance towards easing and a preference for tightening. Okay, so really speaking, there is a little bit of a catch-22 situation going on. Now, if we go take a look at what's coming up for the BoJ on the economic calendar, we can see that before the BoJ decision, we have Tokyo Core CPI, which is coming out 12:30 a.m. GMT, and that is forecast to rise from 1.6% to 1.8%. So if inflation starts to rise, then the likelihood is that the Bank of Japan will try and hike interest rates, but you just never know what the Bank of Japan are going to do. Now, if we look at the Tokyo Core CPI, it's not necessarily kind of, persistent inflation yet, right? If we look at it, it was pretty much on average on the decline since the highs of 2025, which were in May of 2025, where we were up at 3.6%. Since then, inflation or Tokyo Core CPI has dropped all the way down to 1.4% of May this year. In June, we had a reading of 1.6%, which came in line with targets. So if we start to see, again, persistent Tokyo Core CPI year on year, then we should see the Bank of Japan start to hike interest rates. Okay. If we look at some data and we look at some news, right? Financial Times are reporting that investors warn Bank of Japan faces tested inflation, fighting credibility. Reuters are reporting that Japan's price expert predicts BoJ shift to more aggressive inflation fighting posture. So if we take a look at this report here, let's see what it says. So it says, Tokyo, the Bank of Japan may shift to an inflation fighting posture from inflation tolerance as soon as December, which would mean an acceleration in rate hikes, said Tsutomu Watanabe, a former central bank official known as an expert on price trends. Japan is experiencing a third wave of inflation caused by Middle East conflict, following the first wave triggered by the Ukraine war and a second one driven by domestic wage hikes and rising rice costs, he said. The third wave will likely be more modest than the past two, with consumer inflation, excluding fresh food and fuel, peaking near 3% around March next year. Before slowing towards the BoJ's 2% target, Watanabe, an economics professor at the University of Tokyo, said in an interview on Wednesday, but the real concern is the underlying inflation, which is unmistakably rising and now quite close to 2%. As a tight labour market and flurry of price rises lift wage growth, which is huge importance to inflation, and inflation expectations. Such mounting price pressures require a revamp in Governor Ueda's approach of taking rate hikes slowly and tolerating price rises to ensure once deflation-prone economy durability 2% hits. So that's what they're worried about. They're worried about if they hike interest rates too soon, it's going to cause deflation. And they want to try and get out of that first before we see them aggressively hike interest rates. Now, when we look at we look at this combined with some more information as well, if we just look at markets made clear, for instance, we are starting to see a strong commitment of trader signal from the bank, from traders trading the bank, trading Japanese yen futures. Sorry. So if we look at this, we can see that on an index of 6 months and 18 months, it has what's known as a 100% signal. That just basically means that the net commercial contracts at that time are at their most bullish levels for the past 18 months, right? And we can see that reflected in the chart here. If we look at the net contracts, they are at 154,000. And if we look, the last time we were kind of at those areas was towards July of 2024, right? So this is what we've been talking a lot about. We've got this really strong commitment of trader report signal of a potential reversal. We can see that on the opposite side of that, hedge funds are extremely short. They haven't quite met the level still of July 2024. Maybe that will come this week. But combining that with current prices, we can see we're approaching the October 1968 highs. So, if we see another kind of regime from the Bank of Japan saying that they're going to wait a little bit longer, that obviously plays into the hands a little bit of dollar yen, and we could see a move up to that 164.50. Are we going to see intervention? I mean, the talk of intervention has gone on for so long. I think traders are now starting to get a bit bored of it because no one's mentioning the risk to intervene anymore. So they have said that they will act. Some finance ministers in Japan have said they will act if necessary. Maybe, if we did see very strong Fed rhetoric yesterday, we could have seen a spike in dollar yen. But because bond yields have started to come away a little bit, this move down has kind of been, stalled, or the move up has been stalled. Sorry. But 10-year yields are rising, and Japan and 10-year yields have a very strong correlation. So we could see a move up to 164.50 before we see any kind of break to the downside. But here the trend remains up. Would I be buying this right now? Absolutely not. Just because of the situation that's going on here. Now let me just bring in. Let's see if we can have a little bit more, some more data. So let's have a look at the retail sentiment and see where traders are when it comes to US dollar Japanese yen. So it looks like 73% of retail traders, for where this data comes from, so it comes from Awanda, it suggests that 73% are short. So the majority of traders trading dollar yen are short at the moment. I think that needs to flip. I think we need to see them give up, start to decrease those short positions, increase long positions, and then we'll see the reversal coming into the market, right? Because at the moment it looks like we've just got retail traders short, and usually the market does do opposite of what they want to see. So likelihood is we're going to see a continuation of dollar yen upside in the near term with a move up towards those October 1968 highs. Okay, moving on then. So the last part of today is I like to talk about a skill of the day, and we're going to talk today a little bit about the head and shoulders pattern, how to identify a head and shoulders pattern and how that looks to trade. And there's been a really good couple of examples on here, especially on gold recently, when last Thursday we had a sort of head and shoulders pattern appear. So what is the characteristic of a head and shoulders pattern? So the characteristic simply is, let's say the market is in an upward trend, right? It continues to make higher highs, all right? So that is the part of the pattern which is known as the left shoulder, which is the first high, and the head, which is the second high, okay? So that is the high, higher low, higher high pattern, right? So nothing's really technically changed. The right shoulder forms when we usually see kind of like a dip in the market back towards that left shoulder low. Market then rallies and we get what's known as a lower high, and it usually comes in line with that left shoulder. The market then breaks through, completing the head and shoulders pattern. So when we do that, we have something called a neckline of the pattern. And there's two ways that we can kind of trade this. The first way is if price breaks down through and closes below the neckline, we can look for our first short position, stop losses above the high of the right shoulder, and look for an extension down. Typically, you look for a measured move, which measures the top of the head to the neckline. You copy that down, and that is your target area. The second way is to wait for price to come back to the neckline, act as resistance, and then get in at the resistance of the neckline. Okay, so there's a couple of ways that you can trade it. Now, if I just drag this head and shoulders tool from TradingView over to gold, we can see that this is a perfect head and shoulders pattern. So on Wednesday, July 22nd, going into Thursday, July 23rd, on the 30-minute time frame here, you can see that we had a head and shoulders pattern form, right? So the market was making higher highs and higher lows, okay, until the market formed a lower high. What happened then was price broke through the neckline. In this case, it was known as an ascending neckline because the right shoulder low was a little bit higher than the left shoulder low. But what we saw was price broke out, closed below. So in this situation here, on a breakout, you could have looked to short that candle, either sell stop below the low or at market, stop loss above the right shoulder, and a measured move down. So if I was to measure the head to the neckline of the pattern, which is there, and then grab that down, take it to the breakout candle close, you would have had a 1.5R trade. If you'd waited for the breakout of the candlestick low with a sell stop option, you got a 1.2 trade. I mean, this did continue down to 1.76, and then, you know, that would have been a good trade. But then what the beauty of this was is price came all the way back up to the neckline at 41110, and it rejected again. So you could have had two stabs at this head and shoulders pattern with a rejection of the headline with the neckline. Stop loss still probably should go above that right shoulder, depending on how aggressive you want to be. And then you can look to target back towards the original target, which in that case would give you a 1.8R. So those both trades combined would have got you at least over 3R in return there. Brilliant kind of example of your classic head and shoulders pattern, and it performing very, very well. So again, you have to use this within context. Make sure that this is at a strong level of resistance, for instance, or use some kind of you know, why this move occurred in the first place. So the reason why this move occurred was because bond yields were still pretty high, and gold usually goes negative versus that. So very, very strong move here for gold. Very good head and shoulders pattern. Okay. Right, I'm going to leave it there, guys. Thank you for joining me today. If you did enjoy it, leave it a thumbs up. Subscribe to the channel if you're new. And if you learned something new, let me know in the comments. What did you learn today? I'd love to hear your feedback. Thanks for watching, and I'll speak to you in the next one.